This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. A positive lead-in for Asian equities as Wall Street hits a fresh record high. Traders are split on whether the Fed will supersize another rate cut in November. Chinese stocks continue riding on Beijing's stimulus wave, but some analysts say the plans failed to address deeper economic problems. And waning Chinese demand also hurting luxury watchmakers. We get the outlook for the sector from the Breitling CEO, Kern.
And given, of course, that weakening Chinese economy, we saw those broad measures coming from China. Haidi, the debate right now, was it a bazooka? Was it a mini bazooka? But we know that they really ranged broadly when it comes to supporting the economy. Really, those factors, including in the property sector, and not to mention liquidity support for the stock markets. And really, what it did for the global market, sparking that risk-on rally, was really stunning to see how much effect news from China can have on global market sentiment.
Yeah, and as you said, is it a bazooka? Is it a mini kind of bazooka? And certainly there's plenty of doubt across, the sphere of economists and analysts thinking about just the longer term kind of effectiveness of this stimulus package and how it perhaps addresses some of the deeper demographic and longer term structural reasons why we're seeing this slowdown in China. We just had a note out from China Beige Book saying that, this is really the idea that they fired a stimulus bazooka is not actually what happened. We're also hearing from other economists, the likes of Pantheon Macroeconomics, saying, I don't think it's enough to address the underlying issues behind why we're seeing this movement towards a deflationary spiral. What they say is needed is a package of reforms to fundamentally reconfigure the economy and unleash consumption growth. That is a pretty big ask, right, when it comes to, how do you sort of reverse a structural slowdown? A portfolio manager at Timefolio Asset Management, Nigel Pay, saying a lot of the issues are demand or confidence driven. Overall, they don't think the measures can move the needle as the problems are complex. There is no silver bullet. And Shery, I guess that goes to also the view that the government has been reluctant to kind of throw the kitchen sink at this problem, right? Because so many of the elements of this slowdown are structural, are longer term, and perhaps in the longer term, it will not be 5% GDP growth, and China will see that sort of slower for longer growth rate as the new normal.
Yeah, and we have seen those previous rescue efforts have limited success in China, right? But the direction of travel for the PBOC at least seems to be clear in terms of really providing that last resort of liquidity for the markets. And that was really taken positively for markets across the world. And we saw Wall Street also being supported by all of those China-exposed sectors. We're talking about the Golden Dragon Index seeing its best day since July of 2022. We're seeing minerals, materials, really all of the mining sectors also gain ground, even the likes of Estée Lauder, which a bulk of its sales coming from China also rallying. So we had that support. We also had the fact that NVIDIA jumped in the trading session on Wall Street overnight on reports that the CEO might be done selling shares. So that supported markets, despite the fact that at the beginning of the trading session yesterday, we had also data showing that consumer confidence took a hit, dropping by the most since 2021. So that actually pressured markets. Here in the U.S. future session, in Asia, we're really not seeing that much of a change. But of course, we'll continue to watch the Treasury space, given that we continue to see the yield curve steepening. And on watch right now for the offshore yuan, we could touch that 7 per dollar level for the first time since 2023. We're really, really close to those levels right now. We're also watching, of course, what's happening with the Aussie dollar. We had the RBA holding rates steady, but also the Aussie weakening, given that the governor signaled that perhaps there's no rush when it comes to another rate hikes that they weren't considered. And we're looking at Nikkei futures right now. A little bit of pressure, of course. We had 4 sessions of gains already. Not a lot of movement for the Japanese yen, despite the fact that we heard from Governor Ueda as well talk about being in no rush to hike rates. Haidi.
Let's get back to that top story as we continue to see that market reaction to China's package of measures. Let's bring in our China correspondent, Minmin Lo there. So, Minmin, we've had, around 24 hours or so to digest the stimulus package that was announced yesterday. The question is sort of the longevity of the positive sentiment.
Yeah, I mean, if you look at the Golden Dragon Index, it was up, 9%, and the futures are pointing to gains. It was undeniably a very good day for Chinese stock markets yesterday. The CSI 300 had the best day in 4 years. And you look at the yuan, it is strengthening, getting close to that key 7 level. That's something to watch. If it crosses below 7, that will be the first time since May of 2023, and many exporters are watching that level as well to decide when they want to repatriate some of that foreign currency back to the yuan. It could encourage more inflows back to the stock market as well. And you look at the 10-year yield, it rebounded a little bit after hitting record lows. Again, the switching on of that risk-on sentiment as traders move away from the bond market to the stock markets. And let's flip the board. I want to point out a couple of sectors that were doing really well yesterday, especially the property sector. I mean, some stocks flying up 14%, I believe, 15% for Shimao, and that's on the back of those announcements on reduction on down payment ratios, mortgage rates, and PBOC now covering 100% of the funds to buy back unsold homes, up from 60% previously. Now, what this does is it shifts away all the credit risks away from the banks to the PBOC, because previously we had seen the take-up rate for that buyback program being extremely low at about 4% as of end June. And then you have the securities firms as well off the ground. Take a look at the next chart. That's on the back of the announcement that there would be 500 billion yuan in this swap facility for securities firms and funds to tap on to buy back shares, and a separate relending facility as well for listed companies to buy back shares as well.
And yeah, Min, we heard from Bloomberg's Cameron Kreis on his Macroman column that this could be a liquidity sugar rush that risks fading in the short term.
Yeah, so, I mean, undeniably, it's a boost to sentiment in the short term, but longer term, I believe you still need to see that recovery in the economy more broadly, looking at the activity data, the earnings reports, the return of consumer confidence. And I mean, if you look at the recent August data, unemployment, youth unemployment at record high, you have income stagnation. So no matter how much you cut borrowing rates, if people are still worried about their income, the prices, the value of their homes, then going to be still quite precautionary in the way they spend as well. So we have some economists and analysts saying that this is a turning point for China. It's the best day to remember for China's monetary policy. But so far, what's lacking is the fiscal side stimulus as well. We have seen fiscal spending lagging behind. It's down 2.9% year to date so far on the back of the reduction in government revenue because of the collapse in land sales. So some economists are saying we still need to see a whole lot more and a fundamental shift, a shift to the fundamentals of the economy for this to be sustainable in the long run.
Bloomberg's China correspondent Min Lo there. Well, joining us now from our Hong Kong studios, Noah Wise is a senior portfolio manager at Allspring Global Investments. Noah, great to have you with us and a very good morning. It was really quite interesting to see the bond market reaction, right? We saw obviously the 10-year benchmark yield testing historic lows. It rebounded off that. It feels like the market is still quite split in terms of the path forward for Chinese government bond yields. Does this sort of alleviate some of the pressure on the PBOC in trying to stem these bets on a steep economic slowdown that you've been seeing in the bond market?
Yeah, this definitely represents some progress in the short term. I think you referenced a sugar high, but I think longer term, you do need really a healthier, sustainable long-term diet. And I think the things that we would need to see to fundamentally alter the trajectory are, the ingredients to this would include reforms that ultimately push the savings rate down and drive structurally higher demand from the household sector.
There was also hints of more easing measures to come. Does that just inevitably put further pressure when it comes to yields?
I think the signaling is definitely important, and certainly how it was rolled out, right? A broad number of measures all at the same time is certainly helpful, but I think it is an early step on a much longer journey.
What does this mean for the property sector in China in terms of, we have seen, of course, those rescues of property managers and just a broader real estate market in China taking such a big hit for such a long time. Are there any corporate credit in that sector that could still look attractive?
Yeah, I think this is where the longer-term structural issues remain in play. You still have a bigger supply-demand imbalance, so I think that makes it a challenge for investors to really step in the long run. I think it is a good step in the short run. You certainly see that reflected in the equity prices here more recently. But as you note, kind of take the longer step back, and obviously the issues are still there.
And of course, fears about economic slowdown also rising in the U.S. economy right now, especially with consumer sentiment dropping so much. We continue to see this very steep yield curve. Really, we haven't seen such a pace of steepening in previous easing cycles, especially this early on. What does that mean for investment?
It has been quite meaningful in terms of the steepening, but it is not quite as fast as a pace as what you would normally see in a recessionary environment. So we do think this is actually a positive development. You look at the monetary policy easing, the Fed reducing rates by 50 basis points. I think supportive for the U.S. economy, but also probably even more notably important for what that does for global central bank policy. You can look at what the RBA did recently, gives them a little bit more time. The Bank of Japan, similarly. I think there's a little bit less pressure in other regions of the world because the Fed was doing a little bit more and front-loading that, which is leading to a little bit of a steeper curve. But I think that's a sign of healthiness. You did mention the consumer sentiment data, and that was certainly weak. But that is softer data. When you look at the hard data, the recent retail sales figures were very supportive and continue to point to an economy that's growing above trend, north of 3% is expectations here in the third quarter. So I think overall the economy in the U.S. remains in a pretty good shape, and the Fed's plans here are continuing to support that.
Noah Wise, good to have you with us, Senior Portfolio Manager at Allspring Global Investments. Take a look at how we're setting up right now when it comes to the currency space. Of course, we continue to be on watch for that 7 per dollar when it comes to the offshore yuan. If we top that level, it will be for the first time since 2023. And the Japanese yen continues to be under a little bit of pressure right now, strengthening a little bit early in the Asian session. But of course, we had significant pressure, especially coming after Governor Ueda in a speech also signaled again that he was in no rush to hike rates. The Bank of Japan held policy steady last week, and then we had that pressure on JGB yields as well. Later today, Haidi, we do get PPI numbers out of Japan. We'll get a fuller view of the inflation picture. And of course, we're still headed towards a ruling LDP leadership election later in the week on Friday as well.
Take a look at what we're seeing when it comes to the Aussie dollar, right? Clearly, some of the sort of China proxy trades are coming through with that positivity after the announcement of the extra stimulus package from Beijing yesterday. We are seeing the Aussie trading just over 69 US cents at the moment, the highest since February 2023 against the US dollar. It had been trading at the highest since July 2023, so we're seeing that incremental advance there. We did have the RBA, of course, leaving rates unchanged, signalling that it may actually stay at these elevated levels for longer. That gap between the RBA and the Fed just continues to grow, in the wake of bigger moves from the Fed, and now speculation that maybe we haven't seen the end of these jumbo-sized easing measures from the Fed, right? While we more or less still see that hawkish pause maintained for the RBA, that's benefiting that upside to the Aussie dollar. And of course, we had Chinese authorities unveiling that package of support. Broad, the question is to its sort of effectiveness and the longevity of the positivity that we'll be seeing. We are expecting Chinese stocks, so at least for this session, to be poised for further gains, of course, getting that lift from what we saw in the US. Coming up next on the Asia Trade, we discuss Breitling's aspirations in the Japanese market with the luxury watchmaker's CEO, Kern, will be joining us. Port Shelter Investment Management will be along with us too to talk about how signs of a stabilising China will be good for global growth. We'll be unpacking why UBS says Beijing will need to consider even more stimulus. This is Bloomberg.
full-scale war is not in anyone's interest. Even if the situation has escalated, a diplomatic solution is still possible. In fact, it remains the only path to lasting security to allow the residents from both countries to return to their homes and the border safely.
President Biden making his final address to the UN General Assembly, talking about the escalating conflict in the Middle East. The crisis in the Middle East has taken centre stage on day one of the UN General Assembly. Let's get more from Bloomberg's Michael Heath. And, you know, we heard from Antonio Guterres really lamenting what he called a world without rules. Some accusations, you know, thinly veiled as they were towards Israel and Russia.
Yeah, I mean, I think, and fair enough, particularly in the case of Russia. I mean, the international order really in Eastern Europe has broken down on the basis of that invasion of Ukraine. I mean, totally unprovoked and imperialism, basically, in any way, shape or form. Israel is slightly different. I mean, it is defending its borders and itself. It is under rocket attack. It did suffer that horrendous attack in, just under a year ago. But again, it's just the amount of or the scale of the response, I guess, that's the issue. And Israel's it's damned in a way here because whoever it's fighting is always mixed in among civilians. When you go to try to counter that, there's always going to be casualties. There's always going to be errors. Innocent people will die, whether it's women, whether it's children. The images are horrible and the suffering is horrible. And so I think it's a little bit less fair on Israel, but nonetheless, the scale of its responses, particularly in Gaza, are really, there are questions of whether they had to go that hard.
Perhaps speaks more to the ineffectiveness of the UN as a body, in a sense too. But when it comes to Israel and Hezbollah, what options are there for Netanyahu, for Israel? Because they obviously don't want a ground war. Can they avoid that?
Yeah, I mean, it's a really interesting question. At the moment, there's sort of conflicting messages. The general consensus was that they were looking to use pinpoint strikes, and obviously that, presuming it was them, that dramatic attack with the pagers and the walkie-talkies. The aim was to sort of degrade Hezbollah's ability to fire on Israel and to push it back, basically, back to sort of the line that was agreed in 2006 of where it would be, and let Israelis come back into their area and southern Lebanese come back into their spot. The problem is that it's really difficult to do that from the air, no matter how accurate you think your strikes are. You generally need boots on the ground, and the Defence Minister sort of intimated that they are prepared to consider that and do that. But Israel's been here before, and it turns into a quagmire. And in a sense, for Hezbollah, it would almost be an ideal situation because when you're an insurgent group, you're much better off ambushing or potentially even kidnapping soldiers and that sort of thing. And you have to remember also that Hezbollah's fought in the Syrian civil war. It's very battle-hardened and it's capable of matching Israel to some extent.
And Mike, of course, we're also following the ongoing war in Ukraine, and that took center stage at the UN as well, with Secretary Blinken calling out China for supporting Russia. Yes,
I mean, Shery, and it's fair enough as well. I mean, the Russian war machine, to some extent, Russia only has so many resources in terms of being able to keep supplying that war machine, and it does need support. It does need, parts for its factories and these sort of things to keep producing weapons, and they're coming from somewhere. And the obvious ones we know of North Korea, Iran probably, and China is the one that everyone sort of refers to as well. So yeah, I mean, I think it's very difficult to disagree with what Blinken's saying, and it's an extraordinary time if you think about it. Just last month, it was 25 years ago that Vladimir Putin first became the head of Russia, and just where it's come to now, where it's sort of just become this spoiling power that's engaged in wars across all of its borders. When he came to power, it was war in Chechnya. Since then, there's been ones in Georgia and now Ukraine. So yeah, I mean, Russia really, it's really problematic at the moment, and anyone who's supporting it is sort of generating a lot of suffering as well.
Michael Heath there with the latest when it comes to geopolitics. And we have other stories that we're following this hour. Republican presidential nominee Donald Trump says he'll convince foreign companies to shift their operations to the U.S. using tax incentives and the threat of tariffs if reelected in November. The campaign pledge comes as Trump and Democratic rival Kamala Harris try to ease swing state voter anxiety over jobs and wages.
We will set up special zones of federal land With ultra-low taxes and regulations for American producers, these will be ideal spots for relocating entire industries that we've taken in from other countries.
Sources say the EU and China have agreed to continue negotiations on tariffs, even if member states vote to impose levies on EVs. The bloc's vote on definitive tariffs has been delayed and may happen in October. Meanwhile, the EU climate commissioner has told Bloomberg that China's cheap products threaten the transition to a cleaner economy.
We do face a China problem in terms of the non-level playing field we are facing in the European Union. And it cannot be that our companies go bust because the marketplace is flooded with state-subsidized products. That in the end will kill European industry, and we will not allow that.
We have more ahead on the Asia trade. This is Bloomberg. Japan's ruling party chooses its next leader on Friday, and one of the biggest challenges for the winner will be ensuring that economic recovery takes hold across the entire nation, including its vanishing towns. For more, let's bring in Japan economy and government reporter Alistair Gale. Alistair, of course, we have perennial issues here in Japan, but what are the candidates saying about economic growth, and how are they planning to deal with the challenges?
Well, of course, any election is about economic issues, and this one is no different. And what we're seeing is the candidates are kind of acknowledging that Japan still has deep problems, particularly if you go out into the countryside. There's a good story about Japan, which is the markets are doing well, deflation seems to be vanquished, but the feeling is not out there in the countryside. So they've talked about doing things like deregulation of things like ride sharing, trying to kind of encourage new growth sectors. And some of the candidates are talking about using public money to spend to try and encourage growth in the areas that have not felt it, as well as talking about what can the central bank do. And we've seen one candidate in particular, Sanae Takaichi, wants the Bank of Japan to keep an easy monetary policy because she feels that deflation is really not over and it's too early to hike interest rates.
Yeah, Barclays is saying that a Takaichi premiership could actually weaken the Japanese yen. But tell us a little bit about those challenges that Japan is facing. I mean, we've talked about the perennial demographics issues. You're talking about entire towns vanishing. How badly is the rest of Japan doing? Because sometimes we think Japan and we think Tokyo, but there are so many other towns and villages here.
That's right. I mean, this problem of a falling population has been here for over a decade now. Every year, Japan loses equivalent of the population of Detroit. So, it's a long-standing issue. There's no easy fix for this, and the candidates are wrestling with it. We're seeing them talking about, increasing the financial support for for women to have more children, trying to encourage people to not leave the towns that they were born in, because there's a problem of people will gravitate towards Tokyo and other major cities. But really, there's a hollowing out across the country. That's something that's been there for some time. We're seeing a little bit of immigration now, but those structural challenges really remain, and the candidates are kind of trying to come up with new ideas. But honestly, there's not a lot of original thinking out there.
Japan economy and government reporter Alistair Gale, as we preview the elections as well coming up on Friday. We have more ahead on the Asia trade. This is Bloomberg.
IMF Managing Director Kristalina Georgeiva told Bloomberg that the US is a good place when it comes to inflation, but warned that slow growth and high debt is something to worry about.
Two very important points for your audience. Number one, yes, growth is holding, but by historic standards, it is not high enough to retain good prospects for our economies. Before the pandemic, average growth 3.8%. Two, we also have very high debt levels. And that combination of slow growth and high debt is something that we at the fund worry about. What we want to see is countries taking seriously the importance of fiscal prudence. So the central banks have done their job. They fought inflation. Inflation is going down. Rates are going down. We need the fiscal side to be equally committed. And of course, we want to see more attention as to what drives growth up.
I want to go back to inflation, though. With the Fed finally making that big move last week, that half-a-point cut, inflation defeated, mission accomplished, done? Or would you say not necessarily yet?
Well, watch it. Yes, we are in a very good place. We have been predicting soft landing. We would see inflation down and growth still remaining firmly in positive territory. This is where we are.
Right.
We know that in the services, inflation is still flaring a little bit more, so the Fed is going to watch it. But broadly, we think that the Fed got it right, and we would see how that evolves in the next meeting of the Fed. Not to exclude there could be more cuts. But again, why is the Fed successful? Because it is data-driven. So they would watch incoming data very carefully.
IMF Managing Director Kristalina Georgeiva speaking to Bloomberg TV. Take a look at how we're setting up when it comes to just about 25 minutes away from the start of cash trading across major markets. We are expecting still just some of that exuberance when it comes to the China package of stimulus to play through when it comes to some of these China-exposed trades, China proxy, FX, for example, the Aussie dollar, continuing to see upside there. The futures picture when it comes to Australia up by about 0.3% there. Singapore Nikkei futures looking like we might see a little bit more of a lag, and S&P futures looking pretty flat after a fresh record high overnight. Let's get you some of the corporate headlines that we're tracking. Caroline Ellison was sentenced to 2 years in prison by a federal judge for her role in crypto firm FTX's collapse. That is despite her cooperation with prosecutors in the case against her former boss and boyfriend, Sam Bankman-Fried. The judge praised her testimony but said the punishment was needed to deter others from attempting similar fraud. Ellison was also ordered to forfeit $11 billion as proceeds of the crime. TikTok says it's shutting down its music service soon, ending a years-long experiment to compete with Spotify and Apple. The company says TikTok Music will go offline on November 28 and customer data will be deleted. Users were also told to transfer playlists to other services by October. Instead of competing with music streaming services, TikTok says it will now drive users to them via its Add to Music app feature.
Haidi, Swiss watchmakers are suffering from a sharp decline in demand, especially in China, following an unprecedented boom after the pandemic. But Breitling has said it expects to increase sales slightly this year, citing a recent improvement in the U.S. Joining us now in the Tokyo studios, Breitling CEO George Kern. George, great to have you with us today. I know you're very jet lagged, so thanks for joining us early in the morning. I wonder how your business in Japan is doing. We're hearing tourists coming to Japan to buy luxury goods. Is this helping?
Absolutely, it's helping. The yen has been going down a lot versus major Asian currencies. So you have tourists coming from Korea, Singapore, and other China, also areas of the world. And therefore, in big tourist centers, the sales have been increasing.
But you produce in Switzerland, so a strong franc does hurt you.
Absolutely. Well, not only in Japan, but all over the world. The dollar has been going down for a while. And yes, the Swiss franc is a safe haven for many investors. The Swiss franc is rising, so our production costs are increasing, and we cannot just increase prices all over the world. It's impossible if you don't add real value to the watch.
We've seen some industry associations in Switzerland trying to pressure the SNB to actually intervene and help exporters. Would you support that?
Well, it's a free market. The situation is as it is. We need to work on productivity. We need to work on our costs. I don't think that the SNB can really influence that much. The fact that Switzerland, actually we're paying our good economy, we're paying our good performance in Switzerland, but it is as it is, and it has been going on like this since 15, 20 years. So we'll deal with it.
You said that you can't just raise prices to counter this issue. Does that mean you would have to sort of address the production side as well, or are kind of average selling prices being higher enough to counter the drop in sales volume?
Well, as I said, we need to work on productivity. We need to work on efficiency. We need to improve and look for excellence in everything we are doing. But Breitling has been growing all over the world over the last couple of years, especially after COVID, and we are very confident. We've seen now a rise again in the US, so I'm quite confident that for the luxury industry as a whole, we've reached the bottom, hopefully, now.
What about China? For the longest time, it was the core market for luxury goods, but in particular, luxury watchmakers. Do you see sort of the meaningful impact of the economic slowdown, the sort of demise of confidence across household spending? How does that impact your business, and what's your outlook going forward?
Yeah. No, China has been tough over the last couple of months. Now they have announced yesterday a couple of impulses in terms of interest rates. So I hope this will improve the situation. The problem of the Swiss watch industry of many brands is that some of them are dependent on the Chinese market. Some brands are selling 50% to China, 50% of their overall sales to China. Including or excluding even tourist sales to Chinese outside of China. Thank God this is not the case for Breitling. Our sales in China represent 6%. You know, you need to have a plane with 4 or 5 engines. If one engine doesn't work, just hope that the other 4 engines are working, and this is the case for us.
You're just coming from Hong Kong as well. How's the situation there? I mean, we have seen so much pessimism about the city.
It is also more difficult. Hong Kong and Macau. Hong Kong used to be even bigger than China 20 years ago, a huge market, and it has been decreasing. But in the region, I've also visited India, I've visited Malaysia, Indonesia, and all these countries are doing very well. Malaysia is also doing very well. So, as I said, you shouldn't be dependent as a brand from one country only and put all the eggs in the same basket. Europe has been stabilizing. Switzerland is doing very well. USA, which is our biggest market, has been growing strong single digit over the last couple of months. So yeah, let's hope it will continue.
Are you concerned about potential slowdown in the U.S. economy? Consumer confidence just dropping a lot.
Yes, but you know, everybody is talking about a recession in the U.S. since years, and it never happened. So I think the U.S. economy is probably the most resilient economy in the world, and I believe independently on any political changes you might have there, that the economy will be doing good.
George, Breitling makes beautiful timepieces, right, and quality timepieces. I do wonder, how do you explain the gap between the appeal of a Breitling watch and some of your competitors? Is this a marketing thing? Is this sort of a reputational thing? And how do you bridge that gap?
Well, that's the beauty of our industry. There's no checklist or list for success. If we had such a list, everybody would be successful, and it's not the case. In a way, we all make round watches at the end of the day, but indeed it's very different. But let me compare it to cooks. You have 2 cooks having exactly the same ingredients. One cook will make a beautiful plate and the other one a less good tasting plate. And it's the same for us. Our food or our plate, our menu tastes very good.
You mentioned India earlier. We continue to talk about food today. We're talking about the sugar rush of the liquidity in China. Anyhow, diversifying away from China, India, you talked about India earlier. How big is that market for you, and what's the potential? Because there's so much excitement.
Yes, it's one of these. I mean, it's 1.6 billion people. It's bigger than the Chinese market. It has been growing.
But for luxury.
Yeah, it's growing tremendously. Indians used to buy in Dubai or in England. Now you have trade agreements with India, so the market is much more open. The malls, there are many more malls opening, so there's more distribution also for the luxury industry. It will be the 3rd biggest economy in the world in the next 5 years, so it's gigantic. obviously you have a huge difference between the very rich people and the very poor people. I think they need to develop the middle class, but the market is there, the wealth is there. So therefore, I see that many luxury companies are putting lots of efforts into that market, including ourselves. We're opening 2 or 3 more boutiques in India, in all the cities, and it's looking good. And thank God we have this country also.
George Kern, good to have you with us here in the Tokyo studio. CEO of Breitling joining us bright and early despite the jet lag. Thank you. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at what we're watching when it comes to the benefit that we've seen, or rather the reaction that we've seen from the China stimulus announcement yesterday. We're still seeing a little bit of upside when it comes to iron ore. Traded in Singapore, futures there up by 1.7% there. We also saw copper rebounding to that 2-month high on the unveiling of that stimulus. So some of these industrial metals certainly catching the upside on expectations. So perhaps some of the stimulus will make its way through to investment, perhaps boosting the beleaguered steel and construction industries. Oil, though, looking a bit flat when it comes to trading in New York, but holding on to most of those gains. The Middle East conflicts, the next steps when it comes to Israel and Hezbollah, as well as that China story in focus. OPEC, in the meantime, has doubled down on forecasts that global oil demand will keep growing to the middle of the century. The group sees world oil consumption increasing by nearly 1.8 million barrels per day to about 120 million by 2050. OPEC's estimates remain an outlier when it comes to the oil industry. Other players are predicting that demand could stop growing within the next decade. Scientists have also warned that OPEC's view would lead to a climate catastrophe. Let's also take a look at nat gas markets as, of course, the approach of the northern winter is near. Bloomberg NEF sees a slightly bullish sentiment when it comes to prices on higher demand, possible tightening in supply. Our senior associate, Lu Tao, joins us with the details. And Lu, take us through the sort of broader outlook and some of the key forces when it comes to price action.
Yes, the fundamentals are actually suggesting a slightly bullish view to start this winter. North Asia and some smaller markets are driving the demand growth, which is squeezing the available LNG to Northwest Europe. And the European storage level is actually one of the key indicators for market tightness. So in our base case scenario, we project Northwest Europe and Italy's end of winter storage being 40%, which is lower than the 55-56% in the past 2 years. And if this winter is going to be cold, I'm talking about extremely cold in both North Asia and Europe, then the European storage level will theoretically be depleted. So before that, it will forced to come to the market to compete with North Asia for spot cargoes and drive up the prices. And in the meantime, new supply project delays, unplanned outages are tightening the supply. Russian LNG is still in limbo. Some other risks are still there, such as geopolitical tensions and also extreme weather events, if we recall last year's deep freeze across Texas and Louisiana. And these factors could further tighten the global supply balance, the global whole balance.
Yeah, how much of an impact are we talking about from those supply project delays?
Yeah, we've already seen Golden Pass delays, LNG Canada delays, which we have previous factor in this winter, but now they are gone. And in terms of this winter, we are expecting a 4% year-on-year growth, slightly higher than the 2%, 3% in the past 2 years. And this is mostly supported by the U.S. as we are seeing 2 new projects in the U.S. to come to the market. One is Venture Global's Plaquemines Phase 1, the other is Cheniere's Corpus Christi Stage 3. But if you look further and extend the time frame to the next 18 months, and the situation is going to get way better, we expect a total of 9 projects to come to the market, and the total nameplate capacity adds up to over 100 million tons a year. And imagine this is more than the total LNG imports into Western Europe last year. However, delays are more common than not. If all these projects can proceed with their current timeline, we will see a total of 23 million tons of these new supply additions in 2025. But the numbers could drop to less than half of it if all these projects gets pushed back by 6 months.
What are the key markets that you're watching?
Yeah, so North Asia will drive the demand growth we are seeing this winter. One of the key factors is higher heating demand in the city gas sector, as we assume a 10-year average weather compared with a milder winter last year. And also the power sector is driving up the growth as well. Mainland China is expanding its gas fleet. Taiwan is shutting down nuclears and reducing coal power generation, and South Korea is also expecting to lower its coal generation, the power mix, due to maintenances. On the other hand, some smaller markets are also bringing the market's attention. Egypt is, of course, one of the spotlight markets this winter. It is going to import winter cargoes for the first time in years, and the primary reason is the sharp drop in the domestic production, deepening the energy shortage, even with the power demand being seasonally low in winter.
Our Bloomberg NEF senior associate Luja Salver with the latest on the LNG market. And of course, we're looking at the long term. Let's now take a look at the short term, because some gas buyers in Asia seem to be delaying purchases, expecting lower prices. Let's get to Stephen Stepchinsky in Singapore, who leads our Asia energy coverage. Stephen, so what are we hearing from these companies?
You know, what I'm talking about, these markets, these are developing markets. Thailand, Bangladesh have delayed a few purchases over the next month or so. They were supposed to buy for October and November cargoes of liquefied natural gas, and those plans have just been slightly delayed, with the expectation that prices could fall in the short term. We're in the lull months where demand is relatively weak in September, October, and there's an expectation as Europe, as shown by BNEF, as Europe increases their stockpiles right before the heating season starts, you could see prices deflate a little bit more. But that's a risk. And again, that's highlighted in the BNEF report, which shows that winter demand for gas is expected to rise globally, especially LNG. Now, that's being driven by the colder weather, also driven by supply constraints from countries like Egypt and potentially even the United States, and as well as Russian projects not coming online. But there is this view in the market that there's a small window where prices could continue to fall just a little bit before they rise again when the colder weather hits. That's a bit of a gamble, and it could pay off or it could not. It could force these countries into buying more expensive shipments later. Now, when we're talking about developing nations, specifically in Southeast and South Asia, they can be a bit more picky with their prices. They can, if they don't want to use natural gas, they can use other fuels. North Asia is a different story, as again was highlighted by BNEF in the segment just earlier. Asian countries like Japan, South Korea, Taiwan, they can afford to pay a bit higher, and they have to, because their grid and their heating demand depends all on liquefied natural gas. There really are limited alternatives.
Another factor that we're seeing impacting markets is Russia and its attempts to circumvent restrictions. This is quite an extraordinary piece of reporting that you're involved in when it comes to these shadow fleets and individual contacts that have been assembled.
Yeah, so the United States sanctioned Russia's Arctic LNG 2 facility last year. This is a new plant that Russia was hoping to bring online at the end of 2023 and begin exports in early 2024. That had been delayed because of the U.S. restrictions. The whole point that Washington, D.C. is looking at is to restrict or constrain Russia's LNG export expansion. Russia is the world's fourth largest LNG exporter, and they do ship fuel from existing facilities to Europe and Asia, but the U.S. does not want them to expand, despite Putin's goal to triple LNG exports by 2030. And so in order to avoid or circumvent these U.S. restrictions, a shadow fleet, a dark fleet of LNG vessels, just a couple of them, 5 to 7 of them have been assembled around the world to begin exports from the Arctic LNG 2 facility. Some of them have turned off their location tracking software, so it looks like they're in different locations when they pick up the fuel from this facility to avoid potentially restrictions, but satellite images have captured all the exports that have started from August.
Stephen Stepchinsky, who leads our Asia energy team. We have breaking news out of Japan. We are getting the Japan PPI services numbers, growth of 2.7% for the month of August, year on year, slightly above economists' expectations, a little bit of a slowdown from the previous month. But of course, we'll be watching how these PPI numbers translate into consumer inflation as well. We get the Tokyo CPI numbers later in the week, an indicator of nationwide prices. We have more ahead on the Asia trade. This is Bloomberg.
Time now for morning calls ahead of the Asia trading day getting started. And David Costin of Goldman Sachs says the runway is clear for the stock market to keep powering higher once the U.S. presidential election is decided. The bank's chief U.S. equity strategist sees the S&P 500 trading around the 6,000 level a year from now. That would imply a roughly 5% gain from Monday's record close. Costin sees volatility as the U.S. vote approaches, but he says equities have tended to rally after elections. Nomura says China's latest stimulus plan will boost confidence to some extent, but monetary and financial policies alone are not enough to arrest a worsening economic slowdown. The bank's economists say the size of the package may be less than 3% of GDP per year, and markets should place more emphasis on the specifics. Nomura suggests Beijing should provide direct funding to stabilize the property market, increase pension payments to underprivileged groups, and streamline its fiscal system. Shery.
After those measures from China, we actually saw the rally in the offshore yuan, so we're watching that 7 per dollar level. Take a look at how we're setting up in the broader markets, because we're seeing Sydney futures pointing to the upside after 2 sessions of losses. The Aussie also has risen to the highest since February of 2023. Against the dollar, we had the RBA keeping rates unchanged in the previous session. Nikkei futures, a little bit of pressure after 4 sessions of gains. We have a little bit of a stronger Japanese yen, but overnight, we actually saw it weaken against the U.S. dollar. Governor Ueda, in a speech in Osaka, again signaling that he's in no rush to hike rates. The market opens in Tokyo, Sydney, and Seoul are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens as we're coming off, Haidi, from that risk on market sentiment globally. Of course, all really to do with China's stimulus package. We had some broad-ranging measures, right? From just boosting the economy, the property sector, the stock market as well.
As you mentioned earlier, Shery, though, we keep talking about, whether this is a sugar high, right, or whether there's something more substantial, there's longevity to the positive impact that we're seeing across risk assets related to China. A lot of economists saying that this is sort of a good start, but the devil is in the details, and that more fiscally, monetarily, and perhaps more to when it comes to some of these social welfare-related elements needs to be done.
And we'll continue to watch the Chinese markets as trading starts across Asia. The offshore yuan, 7 per dollar, is your level that we're watching right now. We're very close after the rally in the Chinese currency. We also saw the Japanese yen a little bit stronger in today's session, but this, of course, after weakening overnight. We had heard from Governor Ueda speaking in a speech in Osaka, again reiterating that he's in no rush to hike rates. The Nikkei right now unchanged. The topics under a little bit of pressure, but remember, Japanese stocks have already seen 4 sessions of gains throughout the week. And we're also watching, of course, the Friday presidential election of the ruling LDP and who becomes the next prime minister of Japan. Take a look at how South Korea is coming online. Some of those sectors that we'll be watching across markets in Asia will be really materials, industrial stocks, anything related to China. We're on watch. Commodity stocks as well. The Kospi gaining 0.9% after really seeing no big moves in the previous session. A little bit of strength for the Korean won as well, Haidi.
Yeah, and quite a bit of strength when it comes to the Australian dollar trading as that China proxy, right? Highest levels that we've seen since 2023. It was at the middle of 2023, and now we're stretching back to really the start of 2023 at the moment when it comes to trading for the Aussie. Just over that 69 US cent level and up about 0.25%. Some of the other proxies we'll be watching as that staggered session comes online in Australia will be some of the big miners, whether that's going to play through to China's steel industry, which has been under so much pressure, and whether that's going to really see that benefit for Australian iron ore miners in particular. We did see that big jump when it comes to iron ore prices. Most of that is holding, as well as copper prices there as well. And of course, the other side of the sort of elements that we're talking about for Australia is really the RBA rates situation, right? Really a bit of a pariah when it comes to the easing party globally, and whether that is going to kind of push Australian stocks off that all-time high. Certainly that rally could be at risk, although today is probably not the day that we'll see that downside. Watching US Treasuries at the moment as we get further speculation that perhaps we haven't seen the end of the jumbo-sized moves from the Fed. We've had the Treasury two-year yield holding near the 2024 lows. The curve is poised to potentially glide even lower there. The rate cut odds there really rising with, we're also seeing longer maturity yields there being underpinned by the rise that we've seen in commodity prices, Shery.
Let's bring in our next guest, who says China's stimulus measures amount to a mid-sized bazooka. With us now in Hong Kong is Richard Harry, CEO at Port Shelter Investment Management. Richard, great to have you with us. I mean, we've been discussing all morning whether this is a bazooka or a mini bazooka and how long the sugar rush from all of this liquidity can last. What are your thoughts?
Yeah, so the bazooka example is now getting a bit overused. I embarrassed myself on your show in February saying what I thought was China would come in with the big bazooka. That is putting a lot of liquidity into the economy, which of course helped markets. What they've done since then is really done little phases, tiny, tiny little steps, which don't really do any good. All you do is you use up your ammunition. But I think here they have made a real step. Quite a lot of it at the moment is jammed tomorrow. You know, that they'll see how it goes, and they may do more later. But I think we are moving along the line. And I think the key takeaway from all of this is basically that China's gone through, the Chinese markets have gone through a long period of underperformance, almost to a stage where people just don't want to be there. And I think what these moves are saying is that probably we've reached the end of that underperformance. We may not outperform other world markets, but I think we've reached the end of the underperformance. So it may be a time for investors to actually start looking to go back in.
And what sectors would you look at?
Well, I think that when I look at countries, I always look at the sectors that that country, if you like, is famous for. You know, France is luxury. India might be generic drugs, that sort of thing. In China, I think the tech sector is still looking pretty good. Of course, you know, we saw a pop in Tencent yesterday. The tech sector clearly has government support. It's a strong sector all over the world, and the Chinese have to put a lot of development into that sector to counter some of the sanctions that we've seen. But I also think that there's room for maybe looking at a few of the consumer stocks now, especially if we see some more confidence coming back into the market. I think these measures aren't going to improve confidence straight away, and they are very much directed towards, if you like, the asset-owning classes, very much like QE in the US, that a lot of liquidity will end up in the markets, but eventually the consumer will take the hint. And I think perhaps the next step that the Chinese authorities do will try and support the consumer at the grassroots.
Richard, I wanted to get you to our MLive question of the day, and you know, I'm sure there are some views that think that this could be overstating it, but the question asks, could we actually see Chinese equities being the best performers by the end of the year? And I guess to that end, you could say, well, valuations are certainly cheap. This package has perhaps put a floor under, you know, diminishing growth prospects. Could we see bargain hunting really, you know, push valuations up higher?
Well, I think some pioneering investors may well look at that, but of course India is a big competitor to China at the moment for investment too. So I think it'll be muted. I don't think we'll see a big pop. I think this, if you look at this as a narrative, as an event, I think it's pushed the market up a little bit. It'll probably stop underperformance, but whether it'll outperform, I think at the moment is unlikely unless we see further moves.
So it sort of seems like we're in a wait-and-see mode when it comes to China, right? At this point, if you're not sort of going in and scooping up the cheap valuations, would you be looking at sort of China proxies? We've seen a lot of, mining-related, materials-related, even the Aussie dollar, of course, which always trades as a China proxy, doing quite well today.
I think it's probably a little bit too early to look at China proxies. I think as an investor, I would be looking at China again because in the hope that, as I was saying a moment ago, that you're not going to underperform. Performing in line with the world index is probably what you're hoping for at the moment, the least you could hope for. And again, I think I'd go directly into China in specific sectors, just a toe in the water, because I think people are very, very underweighted, and it only takes a relatively small amount of international investment with huge pools of capital in the West to go into some of these markets to start making prices on the margin.
We've been watching the yuan all morning, and we're now surpassing that 7 per dollar level for the first time since May 2023. Again, the offshore yuan getting past that 7 per dollar level for the first time since May 2023. But Richard, really, we have seen a little bit of strength for the yuan in recent weeks. But the question was, how long can it be sustained, right? Especially if we're talking about a potential deterioration further of confidence in the Chinese markets. We're already lost, $6 trillion when it comes to market value in mainland China and Hong Kong as well. So how long can this support last, I guess, is the question. And if we continue to see the decline in sentiment, whether we could also be risking not being able to achieve the 5% growth target the policymakers in Beijing want to see.
Well, I think the 5% growth target will probably be rather understated this year, so that's not really going to be a factor. The yuan, of course, isn't completely freely traded, but it does move according to broad movements in the market, and we have seen period of weakness, and now I'm seeing with some slight strength. I don't think these moves are necessarily going to impress the yuan, especially as interest rates are slightly lower. So I would see it maybe strengthening a little bit, but I don't think there are any particular events at the moment that are going to make it really move.
The focus really is on China today, but of course there's a lot going on when it comes to expectations from the Fed, expectations from the political side of things with the election, not to mention a lot of the uncertainty and conflict in the Middle East. What is sort of the main thing that's attracting your attention that maybe investors are missing right now?
Well, I think we're all slightly concerned that we're seeing a slowdown maybe in certain areas of the economy. PMIs generally over the summer have been a bit lower, but I think a lot of people have been on holiday over the summer. There's still a bit of COVID revenge coming back in there. But I think one of the key indicators that we need to keep on looking at is unemployment. Yes, we had job numbers the other day that were slightly worse than expected, but actually the unemployment level stayed fairly stable. There's still a lot of people out there who actually don't need to work, and I think that's keeping the employment market quite strong. But if I'm looking at one indicator, it's going to be the employment figures, because if people lose their jobs, they will stop consuming, and it's been the consumer that's been at the fundamental to this bull market.
Richard Harris, always great to chat with you, CEO at Port Shelter Investment Management. Take a look at the trading when it comes to the yuan at the moment, as we continue to watch for the implications and how we're seeing a lot of these China-related asset classes play out. At the moment, we're seeing offshore yuan rising past 7 for the first time since May 2023. There's been just a confluence of events, not just, of course, rate cuts from the PBOC, the broader package of stimulus that we've seen from policymakers there as well. We have really continued to watch the impact on the currency. This is the first time in 16 months that we've seen it go past that psychologically key 7 per dollar level. Investors are also considering the Fed's recent large rate cut and the potential for more, right, on top of the slew of supports measures from China as well to boost the economy. So we continue to watch where that trades. At the moment, dollar China down as much as 0.2% there. That level that you're seeing is lower since May 2023 for offshore yuan trading. More ahead on the Asia trade. This is Bloomberg.
Markets are still assessing China's latest stimulus package. Bloomberg opinion columnist Dan Moss says that Beijing has added a touch of showbiz in the rare policy briefing by the central bank chief. Dan joins us now from Singapore. And Dan, really, Pan Gongsheng, not really a household name, right?
He's not Jay Powell. He's certainly not Christine Lagarde. And until now, PBOC press conferences have not been the must-watch that Powell's post-FOMC presser is and Lagarde's post-ECB Governing Council meeting is. But one thing the PBOC appears to have discovered is the power of packaging measures and presenting them in real time. And that was one of the things, having watched central bank press conferences and been reading their statements for longer than I can care to remember, that really jumped out at me. It looks like the PBOC is picking up a couple of tricks.
Of course, the substance matters, but there's also been criticism that with all of the cautious, gently incremental steps that perhaps Beijing's done not much more than waste its firepower, right? How much was that down to perhaps, less forceful communication and showmanship?
After he left office, Ben Bernanke wrote that successful policy these days is 98% talk, 2% action. So yes, having announced the briefing the day before and set in train a lot of speculation, they dared not underdeliver. They rolled out a number of things which in the past different agencies might have published announcements at different times. This event had the advantage in the sense that they had investors' attention. There were several principals up there on the stage, but it was very much Governor Pan's show. And out the initiatives came, bam, bam, bam. So it was really quite something. And, you could see the market reaction in real time. Now, is it going to be enough? Is it a sugar high? Is it a bazooka? All these terms were rolling off people's lips in the hours after this. Yes. Look, it's too soon to tell. But one thing is for sure, Governor Pan appears to have discovered that a little bit of theatre, a tiny bit of Hollywood can go a long way.
And so tell us a little bit about Pan himself then, because all of these central bankers come to the job with a reputation and philosophies of economic policy. He took the helm last year in July. What do we know about him?
Well, what's interesting is at the time of his appointment, he was characterised as having a fairly hawkish perspective. Well, he's done nothing since he's been governor to justify that early tag. There are perfectly legitimate arguments to make about the pace with which China has moved to stimulate its economy, but yet it moves. This guy is showing no signs of being a hawk. Cautious? Yes, sure, absolutely. Look, central bankers come to these jobs with their philosophies and their pet projects, but ultimately, policy is shaped by the circumstances they confront. Now, when Bernanke became chair of the Fed in 2006, everything was about the inflation target. Get a formal inflation target done. Well, that didn't happen until 2012. By the way, he was kind of busy in the interim period. Jay Powell came to office. People thought he was a skeptic about the dot plot. Yet he's been able to use the dot plot for signalling as effectively as some of his predecessors. So things change, but it's the circumstances that make the central banker.
There is an underlying risk to being too charismatic, too prominent, too well respected even within the Chinese leadership?
Look, there's not about to be a cult of personality around Governor Pan the way one developed around, say, Alan Greenspan. That's just not going to happen. China's system is not set up that way. There's one guy in charge. Many news organisations have published stories about how President Xi Jinping has consolidated power in a way that is without precedent since Mao. So, look, there aren't going to be books about Governor Pan titled Maestro, or Back from the Brink, or In PBOC We Trust. But look, the orchestra is starting to get in tune together, and that's worth remarking upon.
Sounds like fantastic books that will go straight to the top of the bestseller list. And Dan Moss, Bloomberg opinion columnist there. Take a look at what we're seeing when it comes to trading in dollar yuan, offshore yuan that is at the moment. We are seeing that pretty significant move with the yuan rallying beyond that 7 per dollar milestone for the first time in, about 16 months. Investors really kind of digesting, of course, a raft of measures that we heard from policymakers yesterday to support the Chinese economy, at the same time counterbalancing perhaps more expectations for outsized moves from the Federal Reserve as well. So that move in offshore yuan extending the rebound of some 4% from that year-to-date low that we saw back in July after that blitz of policy measures on Tuesday, one of them including plans for a stock stabilization fund. So we have seen that continued rally when it comes to the Chinese yuan, largely on that rate divergence, but also now some of the moves that we see from the PBOC and other related policymakers as well. That need for the PBOC to support the currency has also receded somewhat, Shery.
And we're also seeing other Asian currencies gain ground. We're seeing the Thai baht rising to the strongest since March of 2022 against the U.S. dollar. Of course, we continue to see these gains in Asian currencies, especially as we've had that 50 basis point rate cut from the Federal Reserve. That easing cycle has weakened the U.S. dollar and sent Asian currencies to multi-year highs. We're seeing the Thai baht also rising to the strongest since 2022. Of course, a lot to do with also expectations of a stronger Chinese economy. More ahead on the Asia trade. This is Bloomberg.
Full-scale war is not in anyone's interest. Even if the situation has escalated, a diplomatic solution is still possible. In fact, it remains the only path to lasting security to allow the residents from both countries to return to their homes and their borders safely.
President Biden then making his final address to the UN General Assembly, talking about the escalating conflict in the Middle East, and that crisis has taken centre stage on day one of the UN General Assembly. Let's get some more from Bloomberg's Michael Heath, and we heard from Antonio Guterres really lamenting the lack of rules that a number of these parties are, not abiding by. You also heard from Secretary Blinken, calling out the countries that he says are really worsening some of these conflicts.
Yeah, I mean, I guess Russia, in a sense, is sort of at the spearhead of this revisionist movement for the global order, which I guess at heart China is behind, that it wants to sort of reshape things now that it's emerging as a major power. But I think Russia is sort of at the heart of a lot of it. I mean, with the invasion of Ukraine, which, we hadn't seen a war like this in Europe, basically outside the Balkans since the end of, since 1945. And then you've got, the suppliers from North Korea to Russia and Iran to Russia, and then Russia in turn, providing Iran with support and this sort of stuff. So it's almost like this axis of countries that are looking to sort of reshape the global order. Russia is sort of the most extreme example. China tends to be, it sort of has a foot in both camps, because obviously it has a very, very powerful economy, and it benefits from how things work now. So it never wants to overstep it. But you often sort of see these situations where, China's sort of saying, well, we're not shipping any support, providing any support to Russia, and these other countries say it as well. But then suddenly in a small Central Asian state, you'll suddenly see a 200% increase in exports to Russia, which means someone is using that as a conduit into there. So, yeah, I mean, you do see an erosion of the global order, and I think that's right. And, then when we come to the Middle East, Israel is to some extent, well, not some, Israel is defending itself. I mean, it is under fire from missiles. It had that terrible attack, but it's the disproportionate response. It's the civilian deaths, and it's the same with Ukraine. I mean, it's just long periods of states fighting wars or powerful non-state actors, and civilians caught in the carnage that we've just seen on and on and on again.
We're sort of just waiting, I guess, to see what the next steps are in the Middle East, right, and how this potentially plays out. Hezbollah be sort of wanting to see from here?
Yeah, it's an interesting question, Heidi, because it looks like they don't really want all-out war because, you know, I mean, Hezbollah has a huge arsenal of really, really good missiles, and which it could unleash on Israel, but that would be a regional conflict sort of that explodes. What it potentially is looking for is that Israel then goes and puts boots on the ground. I mean, Israel's trying to degrade Hezbollah and degrade its ability to fire into these northern communities of Israel so that it can put its people back there without having to actually send its land forces in, because past experience has shown it turns into a quagmire. You know, a state military is always prone to insurgent attacks or kidnappings or that sort of thing, and it ends up grinding down the country that does the invading. So Hezbollah might prefer a land war rather than these airstrikes. Israel, the exact opposite. It would like to just keep things at a distance, but get it to a point where it's not in Hezbollah's interest to remain on the border to keep firing. It wants to separate the Gaza and the Lebanon conflict sort of thing, which obviously Iran's, you know, its proxies in Hezbollah and particularly Hamas want to see them unite, you know, acting as a front.
Michael, and at the UN General Assembly, of course, this was President Biden's final speech before elections in the U.S. as well. He's been a formidable diplomat, right? Really rallying allies together, partners around the world. What have we seen from U.S. leadership so far in all of these geopolitical conflicts, especially when it comes to Israel?
Yeah, look, I mean, Shery, he's had a very difficult time, and I think you're right. He really, I mean, he's very, very experienced, and he really has demonstrated his breadth of understanding of these conflicts and done his best with them in terms of trying to deal with them as coalitions and sticking with traditional allies. I mean, simple things like backing a democracy like Ukraine against a sort of an autocratic country that's trying to invade it. I mean, these are sort of fundamental Western liberal principles that Biden has abided by. The difficulty for him, though, is that you know the world is sort of changing. It's just various, you know, the idea of sort of semi-authoritarian government or illiberal government is coming to the fore. So and there's so many problems in the world for him to deal with that he might end up looking like he sort of failed. And yet I think that in due time it will show that he has been quite successful there in rallying coalitions to stand together.
Well, there's Michael Heath there with the latest on all of the geopolitical news around the world and, of course, those ongoing talks in New York around the UN General Assembly. European futures trading muted at the moment after big gains overnight in those sectors with exposure to China. This is Bloomberg.
This is basically to ensure this year China can deliver the around 5% growth target. With the stronger support now, I think we're going to see basically some kind of a lifting effect.
We had more fiscal policy stimulus that would certainly be more important in really driving activity here, given the low level of confidence amongst a lot of households and also businesses in China.
Bond issuance quota still quite a bit of left still being unused. So I think that is sort of holding the fiscal stimulus back.
What happened today, I think it actually raised the expectations of more coming, especially for today. It's more on the monetary side, and I think the market would expect there will be more announcement on the fiscal side.
Some Bloomberg TV guests are reacting to China unleashing that package of policy support for the economy. And let's get some more views now from our next guest, who says these measures could help China's growth momentum to rebound slightly for the rest of the year, but she feels that more policy easing is needed. With us now is Wang Tao, who's the head of Asia Economics and chief China economist at UBS. Really great to have you with us. And, this sort of moderated view as to not being too excited about the big sort of policy bonanza, if you will. Do we know enough from the details in terms of extrapolating how effective these measures actually will be?
Right. That's a very good question, right? At this moment, I think we have to look at what is causing the weakness in China's economy. The top reason is the property downturn. It has yet to stabilize despite the various measures that has been announced since even last year and acceleration this year, because these measures have been relatively limited and the demand and supply situation is quite different. And that's affecting local government finances. And the local government has been cutting their spending in various areas, and then affect household wealth, household income, as well as household confidence. So against this environment, the overall production has been pretty okay. So the corporate side, they are seeing a relatively weak demand. So against this background, how effective is a rate cut? I think it definitely will help lower interest burdens of corporates and households. But I think the key thing is to boost demand as well. So from that point of view, I think fiscal policy is going to be more important. And at the same time, I think they need to take more decisive measures and significantly larger scale funding to help stabilize the property market. So I think, yes, it's helpful, but monetary policy alone, or mainly monetary policy, I think is not going to be enough, and certainly more are needed.
You talk about the weakness when it comes to consumption, household sentiment and demand side of things. Does that mean there should be more direct stimulus for households? If we're worried about, a lack of animal spirits, the worries about a deflationary spiral, will more direct payments to households, to, certain parts of society perhaps help with propping up demand?
Certainly, I think so, and many other economists also believe that direct help to the household sector, especially the low middle income households, would help. Well, the authorities have been very reluctant to directly give handouts, so there has been measures in terms of consumption coupons for some home appliances, trading, and cars. I think in addition, the government can increase spending in the social areas, beef up the social safety net in terms of healthcare and pension and so on, especially for the migrant workers who are very hampered in this front. That will help also increase the consumer confidence for a big part of the population. If not direct handouts, more spending, more government spending in the areas that can help boost consumption, more than, for example, just investment.
UBS just recently cut the growth forecast for China to 4.6% this year, right? At this point, can you tell whether all of these broad measures that we've got could help it get closer to that 5% growth target?
Well, yes, we downgraded to 4.6% about a month ago. And with that, we already assumed that macro policies, monetary, fiscal, and property policies was going to be incrementally more positive, more supportive in the rest of 24. And I think these measures announced are very much along that line. So basically, it's already under our assumption and our forecast of 4.6, which means that second half, so third quarter and fourth quarter growth momentum has to pick up because the second quarter Q-on-Q growth was 2.5. It has to go above 3.5%, 4% for the second half growth to be around 4.3%, 4.4% year on year to get us to that 4.6. So I think these measures probably are not enough to get us to 5%. But, it will help support to be around 4.5%, 4.6%.
How long do these measures usually take to trickle down throughout the broader economy? I know that UBS has noted that there needs to be faster issuance and disbursement of, say, government bonds as well, and more support to local economies.
Right. On the monetary policy side, I think it will usually take some time, especially with the rate cuts and liquidity offering. It may take a few months. For the mortgage payment, of course, with the anticipation, the mortgage payment will come down, even if it takes a couple months to actually see that cash flow. I think that will help the household. On the fiscal side, I think they can disperse the funding that's already planned for this year more quickly. They can also ease off on the collection of back tax and fees, as well as ease some controls on local government implicit debt. So that could be immediate. That can deliver some funding to the hands of local governments, and local governments can in turn also help pay off some of their arrears, which then directly pay off to corporates and households.
We continue to see pressure from US and allies on sectors of China's economy that are key to Xi's economic revival plan, right, like EVs and batteries. With that likely to continue post the election, how much of an impact are you expecting, depending on what result we get after November?
Right. I think regardless who is going to be elected the U.S. president, their broad policies on China probably will remain very similar. So I think these sectors, the new sectors that you mentioned, will likely face continued challenge, and also tech restrictions will remain. What's different, of course, if Trump is elected, he had said that he's going to impose significant tariffs on all Chinese goods. So that would be an additional negative shock. But for the EVs and the battery sectors and so on, I think that the tariffs that we have seen that's going to be implemented, I think, from tomorrow. And that current impact on China is relatively limited because China does not export that many of those kind of products to the U.S. Of course, it could hurt potential growth and investment in those areas, and especially if some other countries follow the steps of the U.S. But at the moment, I think China's exports recovery in light of the resilient global growth and also a global upcycle in the technology sector, electronics and so on, is still pretty much intact. And we're going to see exports continue to be pretty strong and contribute positively, very positively to growth this year.
Wang Tao, good to have you back, head of Asia Economics and chief China Economist at UBS. Of course, we're headed towards the Chinese market opens, and stocks just capping their best day in over 4 years following that stimulus announcement. But some traders think that the gains will be short-lived. For more, let's bring in our China correspondent, Minmin Lo. And Minmin, we're seeing the Chinese yuan also strengthen past that $7 per dollar level. How sustainable are these gains?
Yeah, I was going to say that yuan is really strengthening, breaking below 7. That takes us back to May of 2023 when we last saw the yuan heading below 7 as well. People really, I think we have to watch what the PBOC sets as a fix today for a sign of how much the PBOC is willing to let the yuan gain that strength in terms of the pacing of that. And as I said, exporters would be watching, to decide whether to convert more of those foreign currency back to the yuan. And I think it's interesting as well that you just heard from UBS just now that they are holding on to that 4.6% growth target this year, despite that package of stimulus that we heard yesterday. So I guess we're still seeing very mixed reaction from analysts here. Our own economist, Eric Chu, was saying that that package will help China hit the growth target. But if you take a look at the markets, it's poised to open higher today as well. The Golden Dragon was up 9% overnight. As you said, CSI 300 had the best day in 4 years. And you look at global markets, the ones with exposures to Chinese especially the luxury sector, the automakers as well, BMW, Volkswagen, these are the stocks that are rallying yesterday as well. So it's hard to say, yes, there is a big boost to sentiment in the short term, but in the longer run, as of now, we're still not hearing any big banks revising up their growth forecast for China just yet.
And there's a lot of baggage psychologically for investors that have been disappointed by the impact of previous measures from Beijing, right? Is it sort of still a verdict being out in terms of how much longevity we'll see when it comes to the boost for risk assets?
Yeah, for sure. I mean, if you take a look at the CSI 300 this year, you have had that, start and stop cycles of gains and losses, especially back in February this year. You had the CSI 300 gaining as much as 10% from the lows of that month after the CSRC chairman Wu Qing was appointed, and there was a lot of anticipation that there could be more forceful measures to correct the stock market route. So there was that big spike in February, but then later half of the year, the CSI 300 erased most of that gain, and now you're seeing kind of the start of a similar pattern, that big spike that we saw yesterday. And I guess the question is whether that spike will continue, or could we see a repeat of that, disappointment in terms of the policy impact a couple months down the road. And as well, we saw yesterday there were the 3 officials that gave the press briefing, but who was missing ostensibly was someone from the Ministry of Finance. So far, we are still not seeing the fiscal stimulus that markets had been hoping for, and fiscal spending has still lagged behind. Year to date so far, it's down 2.9% because of the collapse in land sales revenue. The issuance of those local government special bonds have been quite slow this year as well because of that. So that's where I think if the stimulus on the fiscal side comes through, it might finally satisfy some of these economists and analysts that have been watching the market for the long term.
Yeah, PBS's Wang Tao just telling us a few minutes ago that she, among other economists, are looking out for really direct payments to households, but we haven't quite gotten there yet. Our China correspondent Min Min Lo there as we get into, of course, the next hour of trading across Greater China. In the meantime, the European Union says it will not allow China to threaten its industries by flooding the market with cheap products as the world transitions to a cleaner economy. The bloc's climate commissioner spoke to us at the Earthshot Prize Innovation Summit in New York.
We do face a China problem in terms of the non-level playing field we are facing in the European Union. And it cannot be that our companies go bust because the marketplace is flooded with state-subsidized products. That in the end will kill European industry, and we will not allow that.
So do you see, when you say you won't allow it, is it going to be similar policies against China to what we've seen in the last 5 years, or could we even see that being ramped up?
Look, I'm one of the people who firmly believes that competition in essence is a good thing, but it should be fair competition. Fair competition at the European marketplace.
What's your take on financing? So if you want to also have something at the EU, again, how do you make sure that China pays its way if you're antagonistic towards it?
Well, this is something for all of us, and it's a fair question for the European Union to continue to play a leading role and to continue to pay its fair share, or actually more than its fair share. Now the world pays roughly 100 billion each year, and Europe does something between a quarter and a third of that, which is way more than our fair share. But others do need to step in, and if you're able, like China, to go to the moon on a mission, then you're also able to pay more in the domain of climate action.
The EU's climate commissioner speaking to Bloomberg's Francine Lacroix in New York. We have more ahead on the Asia trade. This is Bloomberg. Asian currencies gaining across the board across the U.S. dollar right now. Gains being led by the Malaysian ringgit, which is up 1.2%. The Thai baht also touching the highest levels since 2022. Of course, we're talking about a currency in Thailand that's been appreciating for quite some time. So we're expecting a conversation between the Thai finance minister and the central bank governor next week to talk about this incredible rally that we've seen in the Thai baht that's actually led to more pressure on those exporters and the tourism industry as well. The Korean won is also gaining ground, Haidi.
Taking a look at the China effect, Shery, when it comes to the trading that we're seeing across Aussie miners. Of course, we had the jump when it comes to iron ore prices. The reaction to the upside when it comes to copper prices as well. We are seeing that being reflected, particularly when it comes to some of these iron ore majors. Champion Iron is really one of the outperformers, up by over 7%. We're seeing Fortescue also seeing some pretty hefty gains there. Mineral Resources as well as BHP Group just rounding it out there after China announced that series of measures to boost growth on Tuesday. There is some hope that perhaps some of that sort of investment recovery will stand to benefit some of the steel makers and trickle through to iron ore producers as well.
And the latest developments in the crypto space, former crypto executive Ellison has been sentenced to 2 years in prison for her role in the collapse of digital assets exchange FTX. Let's get more with our tech reporter Annabelle Jewelers in Hong Kong. So jail time for Ellison, despite her really helping this investigation move forward and testifying against her former boss and former boyfriend, Sam Bankman-Fried.
Yeah, that's right, Shery. I mean, she was very much a star witness in this case, in that case that was built against Sam Bankman-Fried, which we can get more on that corporation in just a moment. But the headline, as you say, yes, Ellison is going to jail here for 2 years for her role in the collapse, a further 3 years of probation to follow that. She's someone, as you say, she was very close to Sam Bankman-Fried. Not only was Sam Bankman-Fried her former boss, as she was the head of the hedge fund Alameda Research that misused FTX funds, and Sam Bankman-Fried, as you said, was also Ellison's former boyfriend. The surrender date is about 6 weeks from now or thereafter, so November 7, and she's also been ordered to forfeit $11 billion. That's not to say she has $11 billion in her bank account, but it is the amount of the FTX fraud, and so she will need to give up some assets. This did happen at a court in New York where our Bloomberg colleagues were present. They say that Ellison barely reacted to this verdict being read out. She was just really looking down at the floor instead. Her mum and her sister were present, and we're told they were a little bit more emotional. They seemed to be wiping their eyes with tissues, but Ellison didn't appear to be as moved visually by this. She did, though, briefly speak with some of the victims of the FTX collapse and, again, apologise, saying that she thinks about it every single day.
Prosecutors did tell the judge that she deserved leniency.
Yeah, and it goes back to that level of cooperation that Shery was just referencing there. But the US district judge in this, Lewis Kaplan, says he's never seen this level of work that was done, that level of cooperation. So Carol and Ellison met with prosecutors something like 20 times as they built their case against Sam Bankman-Fried, giving what we understand was very full, very transparent, very thorough details, and even directing authorities to crimes that they didn't know about. In exchange for that level of assistance, yes, there was expected to be some level of trade-off. So Carol and Ellison's legal team, for instance, pushed the case for no jail time to be served in prison, probation instead. Officials as well, they had recommended she serve 3 years of supervised release without incarceration. But the judge as well wanted to make a point in this to other people that there does need to be jail time as a deterrent.
Annabelle Jewelers there in Hong Kong. We do have some breaking news when it comes to PBOC market operations, confirming that MLF cut in what could potentially be more good news for risk assets, particularly those either in China or with exposure to the China story. Widely expected, the PBOC lowering the one-year MLF rate to 2% by adding liquidity earlier than the usual announcement time. Not a surprise, but certainly will add to kind of some of the positivity around this China stimulus story. The PBOC is saying in order to maintain reasonable and sufficient liquidity in the banking system, they launched that 300 billion yuan medium-term lending facility, term of 1 year with that winning bid interest rate of 2%. The balance of medium-term lending facilities at 6.878 billion yuan after these operations. So just an incremental bit of good news and support as we get into closer to the start of trading across Greater China. More ahead on the Asia trade. This is Bloomberg.
As we head towards the market opens in China with more policy operations coming from the PBOC and what the markets will do, of course, we've been watching Hong Kong. Stock markets have been depressed. The economy has been depressed. Well, it's said to be planning to lower the amount of tax that it levies on spirits as the financial hub seeks to regain its edge as a premier destination for nightlife. For more, let's bring in Bloomberg Shery. Shirley, what are they trying to do?
So currently, the Hong Kong government charges a tax on liquor containing more than 30% of alcohol. That's equivalent to 100% of the value of the liquor right now. And what we learned from sources is that the government is planning to lower that tax, and this is likely to be announced during Chief Executive John Lee's policy speech upcoming in mid-October. And what we learned from sources is that this is going to be a tiered system. That's one of the considerations that the government is debating right now, because the rationale is that they want people to spend on more premium liquor. So the more expensive the liquor is, the bigger the tax cut may be. And on the other hand, they don't want people to overdrink. That's why, cheaper liquor may not be getting that much cheaper.
So when it comes to the sort of expected effectiveness of this, right, it seems fairly incremental. Does it really kind of go some significant way towards boosting the level of confidence that we're talking about?
So a big part of this is to promote trade of spirits. So Hong Kong government has already had a successful example before. So in 2008, the Hong Kong government removed all taxes on non-spirits liquor. That's including wine and beer and other alcoholic drinks. And after that, the following year, the the revenue generated by the industry increased a lot, and more business have set up related to wine, including like restaurants, bars, hotels, and logistics firms.
Bloomberg Shirley Zhao there with the latest, and we're counting down to the start of trading across Greater China as we wait to see whether this stimulus-induced rally continues.